Hey folks, welcome back to Only Way to Success for another audiobook summary, The Big Short by Micheal Lewis. Steve Eisman started small in the world of finance and mortgage loans in the early 90s. Finance guru Steve Eisman grew up in New York City and graduated from Harvard Law School with honors. His parents, Lillian and Elliot, were highly skilled brokers for the financial firm Oppenheimer in the early 1960s and in charge of giving financial advice to entrepreneurs and investors back then. The only way analysts could impress recruiters and get employed or paid at the firm was by excelling at their jobs. They brought in their 30-year-old son, Steve, as a junior equity analyst when he grew tired of being a corporate lawyer. But in those early days, he was more or less an assistant, whose opinions didn't count. And Oppenheimer's nepotism rules required his parents to pay his first-year salary while the company assessed if he would be worth retaining. Eisman had the talents suited for the job, so he continued after his probation. 4. Children tend to follow their parents' career paths when they grow up seeing their parents happy and prosperous in those fields. Eisman went from being the junior analyst whose opinion didn't matter to lead analyst for Amy's Financial, a new subprime mortgage company, in less than a year. He got this position by being bold and referencing how he'd worked on a deal for a similar company when he was still a lawyer. Of course, he had to learn on the job, but gave it his best shot. The next company he handled after Amy's was Lomas Financial Corp. Eisman advanced in his career to become a unique Wall Street figure. He stood out as someone who was more interested in the ideas in his head than in what anyone suggested. If you are interested in learning how mortgage loans and interests work and discovering how to make huge profits, like Steve Eisman and many other financial analysts by shorting against the subprime market, you've chosen the perfect summary. Eisman had a hard time building his equity business. The mortgage bond was just beginning to make waves when Steve Eisman entered the finance industry. The purpose of the bond was to give credit to those who couldn't afford it, enabling them to buy a new house and cash out whatever equity they had in the one they already owned. The mortgage bonds invented from home loans helped address the problem of early repayment. As mortgage loans became popular and only a handful of people jumped at them, investors started developing cold feet about putting their money forth. The reason was that mortgage borrowers became clever, repaying their loans only when the interest rates were low to refinance cheaply, usually leaving investors with piles of cash when they least needed it. To solve this problem, the finance experts at Salomon Brothers decided to divide the payments made by homeowners into smaller pieces called tranches. The first tranche typically had higher interest rates than the second, and so on. Early in 2004, Morgan Stanley called Eisman to set up a fund dealing with financial companies, including Wall Street, banks, and mortgage companies. Eisman didn't have enough money to achieve his goal and went through many financial challenges, such that his wife told him they would go into another business if this venture didn't work out. Eisman didn't want this. So he tried harder, traveling all over Europe and the United States, searching for people willing to invest with him. He later found an insurance company willing to invest $50 million and attracted people like author Vincent Daniel, Olympic oarsman Porter Collins, trader Danny Moses, and many others. Did you know? Steve Eisman and his wife, Valerie, almost started a bed and breakfast when he found raising funds for his finance business too challenging. Michael Burry and Steve Eisman shorted against the subprime mortgage and made a huge profit. In early 2005, Eisman and his people had formed a group of subprime mortgage machine operators. They aimed to short against the subprime mortgage market. Shorting simply means borrowing and selling a security or stock and then buying it later when the price is low. You repay the loan and pocket the difference. In the mid-90s, subprime mortgage lending was a big deal. Many loans were repackaged as bonds. Subprime lending boomed as interest rates increased. Even as the terms of the loans changed by 1996, 65% of subprime loans had been fixed and known. By the mid-2000s, 80% of subprime loans were given as floating rate, fixed for the first 2 years. The subprime loan market taught the lesson: don't make loans to people who can't repay them. Instead, make loans, then sell them to the fixed income departments of investment banks, which will, in turn, package them into bonds and sell them to investors. Michael Lewis. As of 2005, all the investment banks on Wall Street had joined the mortgage loan game. Eisman suspected some housing and mortgage loans might collapse, so he began planning to short against it. He involved other financial institutions like Goldman Sachs, which was later condemned for its involvement in the 2008 financial crisis. Goldman was said to have allegedly misled investors and profited from the mortgage market collapse. Steve Eisman and another financial investor, Michael Burry, became known for betting against subprime mortgage loans, predicting the falls of some financial investments and profiting from it. Burry took his first risk in the bond market in 2004. After learning about lending and borrowing in America, he decided to bet against subprime mortgage bonds. On his own, he learned about subprime loans and how he could start something unique and beneficial from them. He created a new financial instrument called a credit default swap, which could allow him to short the housing market by selling positions on the assumption that housing prices would drop. Burry's clients grew angry and afraid when banks and creditors argued that the housing market was becoming stable and the prices of houses increased, but Burry continued his short plays. He eventually made 500% profit for the clients who remained with him. More investors made bets against the subprime mortgage bonds. Like Michael Burry did for his clients, Eisman rode on the credit default swap machine to make tons of profit. But it wasn't just them. By 2006, Greg Lippman, another financial analyst who had discovered the same things Eisman knew, met privately with investors to discuss how to make money from it. Later that year, a peer-track hedge fund study showed that almost 14,000 hedge funds had gotten involved. Institutional investors were also allowed to invest in credit default swaps on subprime mortgage bonds. Many also gambled on the relative value of subprime mortgage bonds, buying one subprime mortgage bond while simultaneously selling another. Writing a check separates a commitment from a conversation. Warren Buffett. Some people bet directly against the entire subprime mortgage market and the global financial system. After hearing about it from another analyst, hedge fund manager John Paulson bought several $1 billion of credit default swaps on subprime mortgage bonds. The investors who shorted subprime mortgage bonds became obsessed with gambling and trading. These people, like Eisman, had only just perceived what was happening to the financial system and then made investments against that system. Michael Burry, John Paulson, and others all succeeded in getting on board. John Paulson played the credit default swap game with more investment than most analysts because he raised a lot of money from investors. Another financial investor, Charlie Ledley, used a different approach. He bet on the impossible or what was least likely to happen. Ledley and his partners did this severally with much success. Ledley joined another financial analyst, Jamie Mai, and together they identified long-shot bets that delivered massive payouts. Another trader, Ben Hockett, entered the market and later brought extensive knowledge of capital markets and fixed income trading. He helped Ledley and Jamie's sell off their swaps as the market began to fall, thus earning them more than $80 million. Did you know? A hedge fund is an investment pool that gathers money from mostly wealthy investors to invest in securities or other ventures aimed at producing good profits. Hedge funds are not as heavily regulated as mutual funds and can typically invest in more risky opportunities. The subprime mortgage markets failed in 2007. In 2007, American hedge fund founder Greg Lippman learned that U.S. house prices were falling and subprime loan defaults were rising. So he immediately shorted $10 billion in subprime mortgage bonds. The United States subprime mortgage crisis began later that same year. The financial crisis in the U.S. occurred between 2007 and 2010, contributing to the 2007-2008 global financial crisis and leading to mortgage delinquencies and huge housing price declines. The housing bubble preceding the crisis was financed with mortgage-backed securities and collateralized debt obligations, CDOs. They initially offered higher interest rates, better returns than government securities, and attractive risk ratings. While elements of the crisis first became visible in 2007, several major financial institutions collapsed in September 2008. Two significant causes of the crisis were the rise in subprime lending and the increase in housing. Low-quality subprime mortgages increased drastically from 7% or lower to approximately 20% between 2004 and 2006. A high percentage of these subprime mortgages in 2006 had an interest rate that increased over time. Housing speculation also increased, with the share of mortgage originations to investors rising significantly between 2006 and 2007. The 2008-2010 global financial crisis left many mortgage investors broke and homeless, especially in the United States. Between 2005 and 2007, Mr. Lipman built a massive short position worth $5 billion. In 2008, at the direction of the bank's senior management, he generated a profit for his trading desk of over $1.2 billion. He claimed it made more money on a single position than any other trade had ever made for Deutsche Bank. He made so much money that he left to form his hedge fund. Another early investor who benefited from the subprime mortgage loans was Micheal Burry. He suddenly started hearing unfounded rumors about himself after becoming successful. Some said he had left his wife and gone into hiding. Others said he had fled to South America. He wrote a letter to debunk the rumors and restate his passion for finance trading. All financial analysts who betted in the subprime mortgage market made a profit. Greg Lipman envisioned the end of the subprime mortgage market. On one side, he saw the Wall Street machine making loans and bonds and repackaging some into CDOs and professionals creating fake loans on the other. These discoveries spurred him to go on with his bet. Steve Eisman also realized that in discovering how to sell stocks you haven't acquired and bet afterward, you could make easy money. But he knew it wasn't so right. In 2008, the entire financial system was at risk of collapsing. But in late 2007, Eisman's company, FrontPoint, made bets against subprime mortgages that doubled the size of their fund. Vincent Daniel. Another financial analyst was Steve Eisman's research guy at the hedge fund FrontPoint Partners. He got along well with Eisman despite being from a lower-class area. He played an essential role in investigating subprime mortgage lending to validate Eisman's predictions about the industry. Daniel became very rich from his short position after the mortgage crash. Daniel Moses was Eisman's head trader at the hedge fund FrontPoint Partners and one of their most trusted co-workers. Moses admired Eisman's strong-headed nature and how he strived to rule the financial markets. He was the most optimistic employee at FrontPoint and also played an essential role in gathering information. Despite becoming wealthy due to the shorts, Moses and Daniel later felt bad about making money this way. Every analyst around Eisman, who also bet against the subprime mortgage, saw his bets as insults. When anyone tried to argue that the financial irresponsibility of ordinary Americans caused the subprime lending problem, Eisman would respond by saying it was caused by lenders telling borrowers to lie on their loan applications. He was more against the people at the top of Wall Street's financial systems making the loans than those requesting them. Steve Eisman had insulted and spoken against almost every famous person on Wall Street. Eisman and other analysts' subprime gambles were unreliable, so everyone depended on credit default swaps and waited for more loans to default. Conclusion. The Big Short tells the story of the American financial professionals who predicted and profited from the collapse of the housing brawl in 2006. As seen from this summary, subprime loans fostered the collapse of the mortgage loaning system. Subprime loans meant that the borrowers couldn't afford them but still took them, putting the loans at high risk of default. Lenders then sold those loans to Wall Street investment banks. These banks then packaged them into mortgage-backed securities and collateralized debt obligations. Gambling and investing are very similar. Many financial analysts who eventually profited from these collapses gambled a lot. Some of them include lawyer Steve Eisman, whose parents brought him into the finance industry, untrustworthy Greg Lippman, Michael Burry, who often kept to himself and made silent moves, and Moses and Daniel, Danny and Vinny, who were Eisman's followers. These people were on the short side of the subprime mortgage market. They had gambled, guessed, and predicted, and it ended in their favor in many cases. Many who were short against the mortgage market, including the young men at Cornwall Capital, made millions of dollars. The CEOs of most Wall Street firms lost, but were saved from bankruptcy by the United States government. Those who financed the risk-taking were ignorant of its consequences. They were only after the profits from people who made complicated bets. The men on the trading floor may not have been to school, but they have PhDs in man's ignorance. Michael Lewis. Thank you for supporting our channel. If you like this audiobook, please like and subscribe for more weekly audiobook summary. If you have any specific requests, write down in the comment section.